Welcome to the Real Estate Investing School podcast. I'm your host, Joe Jensen. Our guest today is JD Sustar, the Finance Cowboy. Now, JD didn't come from a ton of money, but he had a strong work ethic instilled to him at a young age by his parents. He played D1 baseball, where he was a team captain, all-conference third baseman. After college, he worked in the service industry, making around $45,000 a year, before learning and transitioning into sales, where he first started investing in real estate. His net worth was actually negative 10,000, and his first flip barely even broke even. So not the most exciting start to real estate, but he now has a portfolio of over 20 rental properties, including single family homes, mobile home park, Airbnbs. He's got a net worth of over $2 million, and he's just barely breaking into his 30s. So congrats on your success so far, and welcome to the show, JD. Glad to have you here, man.
What a great intro. I appreciate it. I feel good about myself right now, you know?
You should. You've earned it, you know? That's awesome. So, man, tell us, how do you go from negative net worth, and you try to get into real estate, you do a flip, which a lot of people's, first thoughts of, oh, how do you make money with real estate, flip a home, and you don't even really make any money on it. Was that like super discouraging, or did you learn enough in the process that you like caught the bug, or how'd that go?
It was a disaster pretty much. I was living in Jacksonville, Florida. I had to be 24 at the time. And I had a small stint in West Palm Beach, Florida, and I'd met a realtor down there and her husband, and I knew they had managed some flips for some folks. And so I got some private funding from a family member and said, hey, I want to try and flip this house in South Florida. These folks, do it a lot. They were my realtors down there. I didn't end up buying a house from them because we moved to Jacksonville. Do you mind lending to me giving this a shot? They're like, sure. So they had whatever the interest rate was, and they had equity in the deal too, but I managed it. And managing a flip at 24 years old, I had no business doing that from 3 hours away, had never done it before. It was so bad, so bad. I don't remember all the details now, but I do remember at one point we thought we were done. City comes in and we had to pull permits for things that we had already completed because it wasn't done up to their code. So we had to knock the walls out, add a bunch of stuff. So this was a disaster. I think we walked away with a total profit of somewhere like $5,000 to $8,000. And that wasn't all to me. Yeah. And so at least we didn't lose a ton of money, but that stung. That was probably that we got it sold in 2016. I didn't buy another property until 2018. And I don't remember everything that I was thinking at that time, but I knew that it was, I got a lot to learn, and flipping on TV is romanticized.
Yeah. It's a show, right?
Exactly. This real life flipping is totally different. And then, we can get into all this, but I learned through other folks that and podcasts and reading books that if you wanted to build wealth in real estate, long-term rentals was going to build that long-term wealth. And so I eventually transitioned to that. I still flip some homes for fun every now and then, but the majority of the time we're holding on to them.
Yeah, it's a big mind shift when you go from like, hey, how can I make money? Wow, there's money in real estate. I like to make money. Money is what buys me nice things, gives me, nice vacations. I can do cool stuff with money. And then to go transition for but wait, what about wealth and freedom?
Yep.
And then how do you battle those two things as you're trying to build your wealth and freedom? But you're like, I miss the money. I miss just having, and tell us a little bit about your transition of thought process and how you reprioritize that.
So I use my W2 as a superpower. I still do to this day. Still have my W2 job because I love it. And, I have a brand on social media, the Finance Cowboy. And that's really what I preach to folks is there's such this message of quit your job, get into real estate full time.
Yeah.
What people don't understand is to get into real estate full time without a large portfolio paying you every month, you're going to have to wholesale, or you're going to have to flip, or you're going to have to be a realtor. Okay. And those aren't glamorous. You could, your W2 job could potentially be better than doing that. Now you can make a lot of money doing those. But if you enjoy your job, right, you like your stability, you like your life, you don't want to have to manage all these flips and wholesaling and cold calling, then you can have your cake and eat it too. And so that's what I did. I said, okay, how do I scale my income doing what I like, which is sales? Well, now, I grown my income, right? And so I was like, okay, I have income coming in. I can live right? I live very comfortably. So how do I build this wealth that is going to truly passively eventually free me from, anything that I have to do and get to where I can do what I want to do? And for me,
Mm.
it was rentals.
What's up, guys? It's Brody Fawcett. Hey, I just want to jump on here really quick and say thank you for tuning in and listening to the show week after week. It means so much to us. Real quick, if you are getting value out of this, please go ahead and leave us a review and feel free to share this with anyone who else you think might receive some value. And if you feel like you could benefit from working with us directly through a one-on-one coach like Joe or through our trainings and online program, head on over to realestateinvestingschool.com where you can schedule a free one-on-one strategy call and dive in to see if Real Estate Investing School will add some value for you.
Yeah, man, I love that. When it's like, I feel like the people, like you said, your W-2 job can be your greatest real estate asset, especially if you got a good active income and it's something you're good at and you enjoy. The only people I see where it really makes sense if they're going to go do flipping and wholesaling stuff is if they want to go run a business. If you're going to go start a company and run a business and do it at scale and do it right, and pour your heart and soul into like really getting that thing up and running, then yeah, get into wholesaling or flipping or whatever, you know what I mean? But
Yep.
doing it as a job, like you're probably better off doing your job like say, because then you have the W2 income, which is so, and I want to dive into that. Obviously your brand is the Finance Cowboy. I think leveraging debt using financing is one of the greatest tools we have at our disposal to grow wealth. So I want to dive into that. And yeah, it's like, if you have more tools to be able to qualify for that debt, then that's powerful. And that's what the W-2 job does. It makes it a lot easier.
Yeah, it's so easy for me to get loans. So easy because I have that stable income and I have that W-2 coming in. Now you can do it without it. So,
Sure.
You can do it both ways, but it makes it ridiculously easy. And so when I have a property, nowadays even though I have really good income and could buy real estate using my own money, and I still put, a decent chunk of my own money into deals. I am now using a lot of other people's money. On the front end, I'm borrowing a lot, which we can dive into that, and then refinancing out with the bank on the back end. But when I first started, I didn't really have those people in my corner, didn't really understand that method as much. And so it was, hey, I'm putting 20% down. I need a bank to lend to me. And you go to that bank and, they don't have a problem lending to you because you have the W-2. And, when you're looking at real estate and leverage, to talk on that, it is very powerful. That's what makes real estate so powerful, is you can buy this very expensive asset with little to none of your money. You got somebody else's money out on it, while appreciation is making it go up in value over time. You can rehab it, make it go up immediately. Tenants are paying down your debt and you're getting tax benefits all the while. And so you can't really do that to that extent in any other asset. And I'm a guy who I got my financial start, I will say, when we first got married, my wife and I, through Dave Ramsey. And so, which was great. It was great when I first started because I came out of college with 60-something thousand in debt, had bought a truck, a ring. And so he helped us from essentially 2013 to 2018, before I bought that first rental, like get our finances in order. And so I don't owe a dime on anything except real estate, which I love. I think it's great. Some people could argue against it and they'd have a strong argument. But for me, I don't have to worry about paying anybody anything except on my real estate. But I remember getting debt on my first property. I was like so ingrained in his thought process, of no debt, that was a struggle for me. But then I was able to realize the difference between good debt and bad debt, real estate debt and consumer debt, and not just real estate debt, but long-term stable real estate debt compared to like a 30-day note or a 60-day note or something that could be called at any time. And so if you're building your portfolio with strong foundations, with good sustainable debt, it's the most powerful tool in the world.
Yeah, man, I think that's so great. And it's funny, the whole Dave Ramsey stuff, like it's almost like he's the right formula to get people out of a hole and get you to zero. Like to get to zero, which is a great place to start because so many people are starting in a hole, and it's like, that's a great financial place to start your real estate journey, is at zero, as opposed to negative. But yeah, like if you can just put that caveat on of real estate debt, asset debt is so different than all the other debts, because that's where you can really grow and shine and do amazing things. I always use the example, I'm like, if you go to your stockbroker and you're like, hey, go buy 10,000 shares of Nike, but I only want to give you $1,000. Like, that's not how it works, kid. You got to give me 10,000. I buy you 10,000, but the real estate, that's literally what we're doing. Like, hey, I want to buy this, $500,000 home. Here's 100,000 or less even. I mean, if you start doing house hack, the power of the primary, that's this thing I've been talking about a lot lately, just the power of primary financing, using it as your primary residence. I mean, you can get 5% down. I've been helping people with VA loans and USDA loan stuff do 0% down. I mean, you're literally paying nothing and you get ownership of the full thing, which is so powerful.
It's unbelievable. It really is. It's a hack.
Yeah, man. And it's funny because I grew up on a farm as well, small town. And it was always this joke like, well, I don't own the house, the bank does, because you owed a mortgage. And I actually believed that for so long. And then I realized, no. I do own it. The deed, the warranty deed is in my name. That's who owns it, which means that's who controls it. And that's who gets to reap the benefit of, like, say, it going up in value, and who controls what debt gets put on it and all these things. Like, even if you have debt on it because you owe a mortgage, you own it, which is a very, very powerful position. The bank doesn't get to decide if they rehab it or if you want to refinance it or sell it. That's your call because you're the owner. They just collect the debt.
Yes. I heard Pace Morby talk about this in a video. I think I was listening to it this morning. He was talking about just making that correlation that if you go to the grocery store and you buy $500 worth of groceries on a credit card, that's not your money. Who owns those groceries, though? You own those groceries. Amex, Capital One, whatever credit card you're using, they don't own those groceries. You do. Same thing like you're saying in real estate. The bank has the loan. It's your house.
Which is powerful. So let's talk about that. Let's talk about financing. So, that's one of the greatest parts of real estate specifically, is how you can finance it. And the lenders like it. You get really good loan terms because it's such a safe, secure investment, as opposed to that credit card. They don't know what you're buying with it. They don't even know you bought groceries. They don't know what you're doing with it, but they're going to charge you 18, 25% interest every month and all these fees if you don't pay it off that month. When real estate, you get, really good terms, getting worse and worse every day. I just checked with my lender today and I was like, oh my gosh, it spiked again and again. So, but it's still a lot better than anything else.
Yeah, no doubt. No doubt. And there's so many different ways to, to get money for real estate deals, like you were talking about. I mean, you can get a VA USDA loan, no money down, house hack it. 3.5% down for FHA loan if you're living in it. 5% down for a conventional loan. I've bought multiple Airbnbs and only had to put 10% down. And then I've done DSCR commercial portfolio loans, and you have to put 20% down. And then I've done seller financing, with a little bit down, and interest rates are a little bit better. And then, my favorite is I use private or hard money or a mix of both, and not have to put any money down, and actually got money back at closing or got a lot of money back at refis. And so there's so many different ways. Even if you're having to put 20% down, like you said, you're still only having to put 20% down of this very expensive asset that somebody else is going to pay for it over time.
Yeah, and I always talk about appreciation. I'm like, you're not just getting 20% of the appreciation when you put 20% down. You get 100%. The whole 100% of the asset is appreciating. So if you have $1 million asset going up 10%, like, that's a lot better than a $100,000 asset that's paid off. Because guess what? That's still only going to go up 10% of the value of the home. The appreciation doesn't care if there's debt on it or not. Yep. Everything's going to go up in value. So it's like, leverage that. And if you can find a secure, safe asset that's cash flowing, that'll cover its costs, and then get as much as you can, because it's all going to go up, and obviously you got to do it smart and not just put yourself over leverage in a bad place. And there's a lot of ways we could dive into doing that, but you do want to own and control as many assets as you can. And it seems like that's something you've been doing Did you start with just conventional loans and kind of maxing that out, or what was kind of your journey with, because you have like more than 20 now, or more than 10, I mean. So how did that kind of go down?
I started with commercial loans. So my best friend got into real estate when we got out of college in 2013. And he had been trying to get me in the game for years. I didn't feel right about it because our finances weren't taken care of. So we get our finances taken care of in 2018. I moved back to South Carolina, and he was like, bro, it's time for you to start investing. This dude was my age and was already worth like $2 million because of rental property. And so he like walked me through that process of, let's go ahead and get you an LLC set up. I'll put you in touch with these small local banks to do commercial loans or DSCR loans or portfolio loans. They're all the same thing. And so the big difference, just for you guys listening who don't know, between a conventional loan and a commercial loan is conventional loan goes against your personal debt to income ratio. So eventually you're going to be capped out because they're looking at your personal debt to income ratio. Whereas if you get commercial loans, it does not affect your personal debt to income ratio. So if they pull your credit, your personal credit, those homes that you own on commercial loans aren't going to show up. And so what that does is it allows you to scale a portfolio to essentially an unlimited number of properties, or until all the banks you went to said, hey, you have way too many properties, we're scared to lend to you, which that takes a lot to get there, especially if you have good equity and good cash flow. People will just keep lending to you. And so I started doing that. The only properties that I have under my personal name is the one I'm sitting in, where I live, and then an Airbnb that I have because I put 10% down as a second home loan. And so I have always used an LLC pretty much, and which is going to call for 10% down if you do traditional financing through a commercial lender. But what happened to me is the first two properties I did, I put my own money in to buy at 20%, and then I had to put rehab, right? Because I was buying undervalued properties. So let's say I'm all in at $15,000 down payment, another 20 for rehab. Well, that's what, 25 grand for the first property. Did that for the second property, and now I'm like, okay, I'm out of money. I mean, that's $50,000 in a couple months, and I may get a good income, but even then, like that hurts you, And so I said, okay, we have got to figure out a different strategy. And that's when I really started implementing private lenders, which are just, you got private lenders and you got hard money lenders. And hard money lenders are essentially people who lend for a living, short bridge loans. And then private money lenders are people in your network, friends, family, acquaintances, uncles, whatever, who will lend for a deal, for a short bridge loan as well. When I say a bridge loan, they'll keep it out for a year and you do interest only payments, and then you pay them back once you refinance out. And so I started acquiring private lenders who would fund my purchases 100% and my rehabs 100%. And so I was able to get into these properties with none of my money in them. The deal with that is you have to buy undervalued deals. You got to buy properties that are at a good price. And so then we would get them fixed up, rent it out, and then I would go do what's called a cash out refinance. And so the bank would reappraise the property now that it's fixed up and has a tenant in it, and they would write me a check for 80% of the new appraised value. And if I did my formula right, then that amount should cover what I owe my private lender, all my closing costs, their fees, everything. And now I own this house free and clear, not free and clear with a bank note, but free and clear of having to put any of my own money in. And so I've really been able to do a pretty darn good job of executing that strategy over, the last few years after those first two properties. And it really allowed me to scale and get to where I am today. And we mix some other things in there along the way too. Like I said, I have a 10% down payment for a beach home. And there's been some properties that I've done a partnership on, or, seller financing, but really learning how to leverage other people's money has given me the ability to scale.
Yeah. And it's funny because people hear that, like, oh, leveraging other people's money. It's like, and that which is like such a cool, because it's a win-win, right? Now that person who maybe probably has no real estate knowledge, and even if they do, maybe they're just so busy doing other things that they can't babysit the whole program like your project, like you're doing. They make money. Like they're making money off the money they gave you. Like, so that's a win for the other people's money. It's not like you're stealing people's money and just spending it and weaseling them out of the deal. Like they're making money off that. And for you, you just know if you find a deal, you can buy it. It doesn't matter if you did one last week or next month. If you find the right deal, you just jump on it. And like say, you can scale. You're not like draining 50,000 a month out of your own savings, you know, and
Exactly.
it's a win-win-win for everybody.
No doubt. And you can get into properties quicker. You got private money, you can close in 7 days. You know,
Yeah.
you got to, jumping back to what you said, you have to change the mindset from you thinking you're a beggar to understanding that you're doing a business deal with somebody. You're not begging. This is a business deal. They're making 10 to 12% interest monthly off of you, you know? So they're doing well, and then you're doing well, and it's a win-win for everybody. And there may be people sitting here saying, well, I don't have anybody. Well, most of us don't when we just start. Networking is huge. I always say there's 7 billion people in the earth, 330 something million in the US. You just need one to really change your life. One person who will decide to lend to you on deals. And I promise that if you can get good at finding deals, the money's the easy part. People get caught up on, I don't know where I can find money. I promise you, if you can learn how to find deals, somebody will lend to you once you start networking in the real estate space. You go to local real estate meetups, join the local Facebook groups, start meeting with property managers and other investors. You're going to run into somebody who will lend for you on your deals, because there's a lot of wealthy people out there who, like you said, don't want to deal with the whole process, or they already have some real estate, or they have a big business in a totally different niche, and all they're trying to do is diversify. And so for them to be a lender, there's a lot of tax benefits to that. It's a safe loan. It's like banks lend to it because it's good collateral, right? You default, then they're going to own that property. So there's a lot of pluses of why somebody would lend. And so it's a big win-win for everybody. And it's something I think everybody should pursue.
Yeah, it's like the key, like you say, is learn to find deals and build trust. If someone trusts you, or they trust the deal enough, but if they trust you, then you can do it. And you can earn trust by doing a couple deals and showing a track record, and breaking down the numbers, and like show them, look, I understand what I'm doing. And they're like, oh, I trust you, right? You can also get maybe friends or family that trust you, and that'll help you break into the thing, but as long as you can get someone's trust, then you can and you know what you're doing to earn that trust, and then you can start making leeway, getting in there. And then once you've done deal after deal after deal after deal, it's like people see that and they're like, oh, it's JD. Like, of course, I'd be happy to
choose, like, which person am I going to use now?
Yeah, because people want to. They're like, dude, if I can take all of JD's expertise, everything that he's been doing for years, and I get to just tap into it by giving him my money, like, that's great. I would love to. And then you get to be picky and choosy, because you can only there's only so many projects you can run at a time.
Exactly. It's a great thing. It is a great thing, but you have to, like you said, you got to build that trust. You have to put yourself out there. You got to learn the game. And then there's a lot of different strategies, to getting in. I don't want to get in the weeds, but a great way to get a private lender to start lending with you is combine them in a hard money lender. So a hard money lender is a professional lender who does bridge loans, and they can close in 10 days or so, but they'll normally only loan you around 90% of purchase and rehab. So you got to go find 10%. So you could come up with your own 10% for that. Or you could go to somebody who's potentially wanting to private lend to you, but they're like, I don't know if I feel comfortable putting $150,000 in, to start. Well, now you only need 10%. So maybe they'll loan you that 15 or 20 grand to get started. You pay them back after the project. Now they're like, oh, that was easy. Maybe let's do the whole deal this time. We'll leave the hard money lender out. And so a lot of different strategies, that I teach and talk with people about. But the key is learning how to use other people's money. And that really increases your ROI and allows you to scale.
Yeah, for sure. So let's talk a little bit about the whole BRRRR method thing, right? So, the BRRRR thing is you buy it, and then you buy it cash, like you said, using the hard money or the private money or your own money, but you just buy it without debt usually. And then you rehab it out, make it nicer, make it worth more. And then you put a good tenant in there, and then you refinance it out. So typically with your lenders, do you have to wait a 6 to 12 month, what they call seasoning period? Or do you have it set up with your lenders that they'll give you appraisal value soon as it appraises?
So yeah, my lenders we can start the appraisal process before I ever get a renter in there. So this whole seasoning thing, it's true with some lenders, but there's plenty of small local banks who do not require that.
And is that because you have a relationship with them and you've done multiple deals? So they're like, we're not going to hold it. He'll make you do it, or they're just cool with it either way.
No, they just say, okay, this property's worth this amount now. We know it's going to rent for this amount. Let's go ahead and refinance it out, And so every bank may not be as lenient as some of these around here are with refinancing before you even get a tenant in place. And it could be based, they're looking at your income outside of, that property, and they may look at some of your other properties too. So there's probably some factors that go into that. But as far as the seasoning period, even if we just ran BRRRR, how it usually is, buy, rehab, rent, refinance, repeat. Once you get it rented, if you're dealing with a small local bank, they don't have to play by everybody else's rules. And so if they see it's rented, even though you've only had it for whatever, 2 months, 3 months, you should be able to go ahead and get it appraised and be able to pay yourself back. So, I always say that the seasoning period is a little bit of a myth. It's just a blanket statement that doesn't apply all the time.
Yeah, and that's one thing I tell people with lenders. Like, if you get an answer you don't like, call another lender. Like, there's lots of different answers, and especially when you get into these commercial DSCR portfolio, whatever, they need a better name for these that everybody can use. But, when you get into these loans, like you said, there's no rules. It's whatever that bank feels comfortable doing, and they can do whatever they want. And that's where the relationships do, because some banks, they don't care. Some do. But if they like you and they trust you and you had a relationship with them, they might go against their norm because they do like you. So it's like anything can be done if you can get the lender to feel comfortable doing it.
Yeah. And these small local banks, again, are just awesome for that. The larger banks, they're going to have their ducks in a row and not be as lenient. But when you can talk to a VP of a bank, you got a good chance of getting stuff done. And so, I've worked with local banks here who they're not quite doing it right now in the way the current market is, but they used to lend off the appraised value. So if I was buying a home for $150, but it appraised for whatever, $175, they would lend me 80% off of that $175 instead of 80% off the purchase price. So again, they can just get creative, which means I've gone to closings before and got cash back because
you're saying even without the rehab or anything like that, because it's not typically what you do is get them to lend on the appraisal value, but normally you have to go through a whole rehab process and put a renter in there, show that it's stabilized, it's bringing in income. But you're saying even before rehab or stabilizing, if you just get a good enough deal, you can just get it off the beat.
Exactly. And then you got to find really good deals. But this one, I don't remember the exact numbers, but the first one I did, I don't know if we got it like whatever. The purchase price was like 60 or something, but it appraised for 85, somewhere in that ballpark. And they just lent me off of the appraised value. And I ended up getting $2,000 back.
Jeez, I need that right now. I've got a deal. I've literally got it probably 60% below value right now. This guy just wants out of it. Right. And I just I'm on a lender that'll do that for me. I'm like, can you just give me it on appraisal? Like your loan to value risk, your LTV for the lender is like 60%, 50%. I'm like, it's so low. So I need to find a lender that'll do that right now. And it's weird times right now, man. Like I say, I just called this DSCR lender and they wanted, it was like 8 to 9% interest, or I think 8.25, 9.25. Like these interest rates are just really, really high right now. So how do you play that game? So this is one thing with the BRRRR I always have a issue with, right? Is you buy it, you use the hard money, the private money, you've got all these expenses into it, repair costs, and you got to pay back all these people. Like, how do you make sure that you're safe and they're safe when you turn around and go get that long-term financing and it's like, it's volatile, it's going up, a week ago, it was a point or so, 1.5 less than it is today. Like, how do you play that game and hedge that risk?
I think you have to be conservative when you're underwriting, and that protects you. I always say you got these variables. You got rent, you got purchase price, and you got interest rates. Okay, now there's a lot more that goes into it. Let's just look at those three. Hardly ever do they all three align, where it's like they did like in 2019, I'd say they all three were aligned. Like you could still get stuff at good prices, rents were high and interest was low. And so as an investor, it's like, oh, this is easy. Okay. But then we hit 2021 where it's like purchase was high, and interest started getting high. Well, now that makes it harder to buy. Well, now we're kind of on this side where now homes are starting to sit longer. So prices are coming back down. Okay. Rents are still stabilized, at least in my area, but rates are going up. So we have to we have to take into account that equation and say, okay, if rates are higher, then we got to do one or two things. We're going to have to get this property at a better price, right? Or our rents have got to be better. And so that's how I look at it. When I started investing in 2018, commercial loans were about 6%. The last deal I did in December, I paid 6.25. I think right now my lender's at like 6.8. So they're going up, but it's just, I know, okay, things are going up. Interest rates are going up. So I need to account for a potential raise by the time I refi, right? So run my rates at a little bit higher on my underwriting, which means that tells me I have got to get properties at a better deal than what I would think I need to get them at right now.
Yeah.
And, it can make it tougher. You got to make a little more calls. You got to dig a little more deeper, but the market's starting to help us out a little bit as well, because homes are sitting so long. And so the last two deals I got, they were both off Zillow. Like, it was so easy. One of them was listed for 130, got it for 90. Okay.
Nice.
The other one was listed for 140, got it for 105. And so this is just listed properties. Okay.
So walk us through that. How did you get it down? Because that's always fun to hear, like, the stories, and every situation's different, obviously. But for those two, like, how did you get it down so low? Did you just offer less, or did you get under contract first and then work it down? Like, how did you get it below asking?
Yeah. So we'll talk about that. The deal where I got it for 90K. You have to know why the seller needs to leave. And if you don't, it's like in sales, if you don't know what the customer needs, you can't get them what they want or need. And so I knew they were trying to leave to get to Michigan quick. Okay. And so I walked through it with the contractor, on the front end, and we felt as though, we were going to have to put, I don't know, 30 grand into it, somewhere in that ballpark. And then I felt after repair value was going to be somewhere in that 175 ballpark range based on comps. And so for me, my formula went, because I know the bank will refi me 80%, right? After it's fixed up, the bank will write me a check for 80% of the new appraised value. So my formula was after repair value. Okay. So what are the comps saying? What's this home going to be worth after it's repaired? Times 80% minus rehab tells me my purchase price. Okay. And so my after repair was 175. So, and then multiply that times 80%. What's that? I'll do it on my calculator real quick. 175,000 times 80%. That's 140. And then I said we were going to have about 30,000 in rehab. That put me at 110. Okay. So I offered on this home at 100, and I showed them, like, hey, this is what we walked through. This is what we feel needs to be done. And I know you guys need to leave quick. We can close in 7 days. All right. So then I get my inspection done after they accept my offer at 100. Then I leverage that inspection to say,
hold on, real quick. You could have done it at 110. You offered 100 to have a little wiggle room in case they came back, but they accepted the 100.
Exactly.
So your lowest was 110. They accepted 100. You go through it and then you do an inspection. And then what happens? And
then I leverage the inspection. I always say real negotiations don't start until after you get the inspection.
Right.
And I took that inspection report and said, hey, the septic's leaking. That was a big deal. We had a couple floor joists that were out of whack, things that we didn't account for. So this is going to cost me X more. I need to get it at $90,000 for it to make sense for me. And they are already under contract. You got to think, this home had been sitting for over 30 days. Market's in a wonky place. They already have this house under contract. I have the leverage here. I can close in 7 days. And they accepted it. And so, I wouldn't have paid any more than 110 for this property. Could have still had a decent deal. But I was able to keep pushing and keep digging deeper and showing why. I didn't just throw out lowball numbers being a jerk.
Yes.
I am very detailed on this is why I am buying this as an investor. There's some advantages for you because of that, but I have to get it at blank for it to make sense for me.
And I always encourage that. I think that's so key. Like as investors, you're like, you're not lowballing to just see if you can get it for less. You're not just being a jerk. You show them the numbers. You're like, look, this is what things need to be. Like, sorry if that's offensive. It has nothing to do with the value of your home. Like, that's awesome that repainted the kitchen last year. Like, you're
Yeah.
not trying to offend them. You're like, but these are where they need to be. It just is what it is. And it makes it less emotional for you as well. You're not like, you're just like, well, that's just what it is. It doesn't matter if it's 20,000 less than they're asking, like these are the numbers that work. So you work with what works.
And these people, the majority of them, I'm buying distressed properties. So they're not naive to thinking like their home's in pristine condition either.
Right.
So it's like, you got to understand, you have limited your buyer pool because of the condition of this home. And so, it's either take it or leave it. So I get done with that rehab and we get it appraised at the bank. It appraises for 170. I'm all in at 122. Okay. Bought it at 90, ended up being 32 in rehab. So I'm in at 122. The bank wrote me a check for 80% of 170, which was $136,000. So after everything, say I'm all in at whatever, 125, 126, whatever, I got around $10,000 in my pocket after paying private lender back, after paying closing costs, everything. Not only do I have this equity, I only have a loan for 136. It's worth 170, but also got cash in my pocket because we had such a good deal. And so it's a very, very powerful strategy that can build wealth in a plethora of different ways.
And how long ago was that you did that deal?
So that one was in October.
Right. So that wasn't 10 years ago, guys. Like for those listening, and you honestly, we haven't even addressed this. You just started doing this, less than 5 years ago, and you've built such a huge portfolio in less than 5 years, because of the strategy you're doing. You can scale that way. But these deals aren't all 10 years ago or 20 years ago, or it's like, oh, well, yeah, back in the day, even 3 years ago is back in the day nowadays,
Exactly.
Anything 3 years ago was like amazing,
Yeah.
But you just did this. I mean, we're just talking a few months ago, right?
And the second one was December. So that one was just happened.
Yeah, and that's awesome. And so and the key thing is when you go and refinance this and you get all that money that you put into it, your loan payment is still less than your rent. You're still able to rent this out in cash flow and have it cover its own costs. So you get a free house that's actually covering all of its expenses, and you got all that money back. And that's the key thing, because you could go to refinance, but by the time you finance for that much, if you can't rent it out for enough, it's like, well, yeah, but now you're losing money every month because your mortgage is too high.
Exactly. And you have to factor that in on the front end. And so I called property management companies and knew what it was going to rent for, 1,500-ish. And I have a loan on it at 136. And, when I ran the numbers on that, I think the cash flow was 200-ish a month. So now, and to get into the cash flow talk, 1 or 2 rentals isn't going to make you guys rich off cash flow. I hate to break it to you. It just doesn't happen. I'd say the average cash flow is probably $200 to $400 for a long-term rental. Now you get an Airbnb, it's a different story, but Airbnbs are so expensive right now. It's hard to find one that makes any sense.
And they're an active income. They're not passive. It's like it's daily, weekly, it's not like once every 6 months you switch tenants, or send a plumber out, it's like, it's an active income, and that you earn it. You can get paid 5 times as much, but you're working for it.
You are working for it. But that's why scaling is so important on the long-term rental side is because, maybe one property that's producing you $200 a month in cash flow isn't life-changing, but we talk about 25 properties that are doing $200 a month in cash flow. Now we start putting a dent in some of our personal expenses. But even to me, cash flow is the cherry on top. And, it can be a debatable topic. I'm well aware of that, but I am just so focused on the long term that I'm not going to lose a deal. If that deal would have paid me $50 in cash flow, I still would have taken it. I wouldn't let it go, because what I have seen over my, almost 5 years of doing this is the real wealth comes from time of you holding a property, letting it go up in value while tenants are paying down that debt. And you have this spread of equity. And that's where real wealth, and you may say, well, that's just equity. That's just paper money. It's paper money until you do a refinance and you pull it out and you don't have to pay any cash, or you don't have to pay any taxes on it. And now you just pulled out $40,000 and you don't have to pay a dime in taxes. You got $40,000 in your pocket. You do that 3 times a year, right? That's 120 grand a year, but you're buying 5 to 7 properties to replace those 3 that you just refied with other people's money. And you start saying, oh, wow. Yeah. I kind of see how that makes sense, and that takes a little bit of time to get there. It's going to take you 3 to 5 years to get to the point where you can start doing things like that. But,
and even if it takes 10 or 8 to 10, you had a good 3 to 5 years, you're at the right time, but for most people, maybe it'll take the next 5 or 10 years because of the market. Who cares? If you get a house for free, the way you're doing it, it doesn't matter where your cash flow. Like say, if it takes 10 years and now it's doubled in value, it's like that's wealth. Like you said, that's how true wealth is grown, is through the appreciation and the equity increase, from the rehab and the time in the market and et cetera.
100%. 100%. So I never get caught up on a few $100 in cash flow personally.
Yeah, and especially like I said, I love your strategy doing the BRRRR stuff is because you don't have to look at, well, what's my return on my money? If I'm tying up all of my cash, then you need to get a certain return. The cash flow needs to be high enough because you're like, well, I just put 50,000 into this thing. But if you get all your money back, it's an infinite return, so you don't care if it's a $50 or $400 cash flow, whatever, as long as it can self-sustain the assets, you never lose it. Yep. Then it's like you're good to go. But that takes some work too. That's the thing. The BRRRR thing sounds so cool on the front end, but then you're like, wait, you actually have to go be running a flipping company. You have to know how to rehab it. You need to know your expenses. You need to project these numbers. And I'm assuming you have these loans lined up as well too. You're not just hoping you get a loan later. You've probably got an institution, a lender's lined up that knows you, maybe has even looked at the asset on the front end and is like, okay, like you're pretty confident you can get a loan on it to get all your money back out.
Exactly. Yep. I got 3 or 4 of them that I built relationships. I started with one, who took a chance on my first deal. It worked. And then they did a couple more. Well, then I went to another one, just was seeing what other products were out there and worked with them. And then just, you start building these relationships and people want to work with you. A bank's job, among other things, is to loan money. And so if you find good deals, they will loan you money.
Yeah, they want to. They have to. They have quotas for it, right? Like I had a buddy buying a big apartment complex, like a 50 unit or something. And he was able to work out a really sweet deal with the existing lender on it, right? Because they didn't want to, lose this millions of dollars worth of debt and have to go find that somewhere else. They were like, no, we want to keep our loan on the property. What can we do to work with you now that you're buying it? And so he worked out this awesome deal because, again, they want debt. They need debt, and they don't want to lose the debt that they have. If
exactly.
it's good.
And they don't have to pay all those capital gains up front either. If he's paying them a portion each year, that, instead of them making $5 million in 1 year, well, maybe they're making $300,000 off your buddy each year. Well, that's a lot in taxes. There's so many different strategies, especially when you get into those big properties where you can get real creative. And you're dealing with savvy folks. When you're doing a lot what I'm doing with these single family, you're dealing with a homeowner most of the time. Often, also I'm buying from other investors as well, but a lot of times you're buying from a homeowner and they just want the property. But you start digging in the multifamily space, and it's a totally different ballgame.
It really is. So tell us a little bit. I mean, we're almost out of time somehow. We've been chatting for like 45 minutes. It's like my favorite topic. And out of all of real estate in general, I do love the power of financing and using leverage. So it is exciting. But tell me a little bit about your approach when it comes to rehabbing and contractors and rehab budgets and going overtime and going like how do you approach that for somebody that hasn't really done it? And they're like, oh, well, I'm not a contractor. I don't know how to run a flipping company and rehabs and all this stuff. And like, there's just so much money committed to all these things. Like that can be really intimidating. What's your advice to someone just getting going on their first or second or third BRRRR where they don't have a team of trusted people yet?
Number one is when you do find a contractor who does what they say they're going to do in the right amount of time, hold on to them. Do whatever it takes to keep them close, because you can talk to any seasoned investor. This is the most frustrating part of real estate, but it's a part of real estate. So suck it up. If you want good deals, you got to buy them distressed and put money into them. That's just the name of the game. And so, the best way to find them is networking. So property managers are a great place to start. They know a ton of different contractors, other investors. You can get on an app, any app, but that does this, but I use Landglide, and I'll look and I'll see what other investors are in the area. So I'll just hover over properties and see which ones are owned by LLCs. And that tells me that person's an investor. Then I'll look them up, shoot them a text, go to lunch with them. Right. And hey, so who do you work with? You got any, lenders you recommend or contractors? So really dig into the community real estate meetups. And then you can also use Google, see which companies are rated high, or maybe you got like my guy right now, is a gentleman from church. I know him from church. And so he's been running point on this. And so I think when you're first starting out, it's important to get quotes from multiple guys. Now, I don't do it right now because I got my guy. Okay.
Right.
But when you're starting, get 3 different quotes. That's a good number. 3 different quotes, and tell them you need it itemized. Okay. Everything itemized. And then you need a timeline as well, and talk about communication. Now, we could do a whole episode on rehab. But,
yeah, for sure.
But, you may say, well, how do I know what to rehab? I'll try to do this in 30 seconds. So get an inspection report always. I always get a home inspection and termite inspection. It's just what I do every single property. And start with fixing the nuts and bolts. So you need to get plumbing up right. You need to get electrical right. If you got any foundation issues, I normally take care of that on the front end. And like I don't always replace HVAC units by any means, but like if ductwork's messed up underneath. So I try to take care of, okay, what's going to hit me in an inspection underneath this house? Can I go ahead and get it taken care of now? Because you got to realize, again, a lot of times I'm using other people's money. So if I can get this done with somebody else's money on the front end, it's going to help my returns on the long run. Plus, if we get that inspection stuff taken care of on the front end, then if we ever go to sell the house, we don't have as much to do on the back end. And so I'll take care of those nuts and bolts. Okay. So plumbing, electrical, HVAC, foundation. And then we go in. And so the biggest thing I did when I was early on in my investment career was I spent too much money on rehab. And you do not want to spend too much money on rehab in a rental property. So you want to make sure that we're doing, fake wood floor, LVT flooring. I'm usually not redoing an entire kitchen. If they're terrible, if the cabinets are terrible, I'll reface the cabinets, or oftentimes we'll just paint the cabinets, change the hardware out. When it comes to bathrooms, we're not tiling. We're not doing a tiled shower and expensive vanities. We're going and buy the $150 vanities from Home Depot or Lowe's, and we're doing those insert showers. Tubs, if they're, a lot of tubs will look dirty. Well, you can bring people in to stain those tubs. So we'll stain those tubs. Again, put a cheap vanity in, and you just don't want to go luxury. So you want to, paint, clean up drywall, not real hardwood floor. You can make bathrooms look really good for a little bit of money. And, that'll get you to where you need to go. And there's a lot more details on that. Sorry, we don't have time to dive into all that. But the point is, you're not doing what Joanna Gaines is doing on her show. You're keeping a rental because it's going to get beat up. So we want a good working living condition, but we do not want to set it up to where it's ready to sell on the market. That means you spent too much money. You have too much money in the deal, and you probably need to flip it because you just got a bunch of money that you didn't need to tied up into it.
Yeah, it's rent ready. It's not dream home ready. It's rent ready, and again, that's a lot better than it was when you bought it. You know what I mean?
Oh, yeah.
It probably wouldn't even qualify for debt on it. The banks wouldn't even lend on a lot of these properties because the one I'm looking at right now, it has a hole in the roof. Like literally, there's a hole in the roof, and that's why I can get such a good deal on it. The guy moved out of state, doesn't want to deal with it. It's leaking. It's getting worse. It's like, just take it off my hands.
Yeah.
I can't get debt on that right now with a hole in the roof,
Exactly.
And so you go in, you clean up the hole, you do these little things like you're saying, you get it rent ready, and then the banks will lend on it. You can get tenants in there and it's good to go, but it doesn't need to be dream home status.
Exactly. You'll be surprised what cheap little vanities, ceiling fans, fake hardwood floor, and paint will do.
Mm-hmm.
I'm not talking about the nuts and bolts underneath the house plumbing. I'm just talking about the aesthetics. You spend $3,000 on painting a house, 1,500 square foot house, spend 4,000 on flooring, and then fix up the bathrooms and the kitchen. I mean, that puppy will rent right away.
Yeah, that's awesome. Well, sweet, man. There's so many things we could dive into. We'll kind of start rolling into the end here before we let you go. Obviously, there's so much more you have to share. I mean, I love your content. What is the best way for people to learn more about you and more from you and everything like that?
Social media is a great place. So Instagram at Finance Cowboy, TikTok at The Finance Cowboy. Somebody had stole at Finance Cowboy on TikTok, at Finance Cowboy on Twitter, and Finance Cowboy on YouTube as well. So you can find me on any of those places. I put out a ton of free content. You can also go to financecowboy.com. I have a ton of free resources that I put together for folks, guides and checklists and everything else. And then we also have a, course and coaching program that we launch a couple times a year. It's closed right now, but we're opening up the wait list this week. So, that's kind of what we have going on in our world. And I really enjoy it, man. My favorite part of this entire brand is being able to put out the content. The free content is like what I live for. And so would love to have you guys come and check us out.
Well, it's so cool. I love learning from so many different sources because it's like real estate, even though there is a part of it that is a science, like it's also kind of an art. Like there's so many ways to approach it. And there's just so many opinions to it. It's not like, well, 1 + 1 always equals 2. That's the math. It's like, there's a lot of different strategies and angles and variables and stuff. So it's like one person's way that is just money is different than another person's way. It's cool to see all the different options. So I encourage everybody to, check you out and check out tons of different stuff. But, learning how you specifically do it has been really fun from what I've been following and everything like that. It's really cool.
Awesome. Yeah, thanks, man. We really lean into, the average everyday person who is working a job, raising a family, because that's been my story. Still to this day, work a W-2 job. And so I really hone in on that, on like, how do we do this without having to sacrifice our whole life? I got kids, sports and church and work and family. So you can do both. And that's one of the things we really talk about.
I love it. I love it, man. Well, has there been any specific, kind of guiding principle or habit that has really paved the way for you over the past 5 years as you've transitioned to this new life?
I real estate wise, what really changed it for me at the beginning was getting to the mindset of not investing in real estate was riskier for my future than investing for real estate. If you have anybody listening to this who's scared to get started, you can brainwash yourself into really believing that will change your life drastically, because I have been at the place where I was scared to buy that first property, and now I'm at the place where I'm reaping huge benefits from doing it. And so if you'll just trust it, you just got to say it's worked for millions of people for centuries. It'll change your life. And then others just, generic is keep going. There's a lot of hard things in life. A lot of times you get beat down, a deal doesn't work, or, something at work, struggling, family, whatever, just keep going. The folks who don't quit and the ones who can pivot and keep trying, they're going to come out ahead.
I love that. That's great. Well, sweet man, we'll roll into our final four and let you go back to your family. So first question of the final four, JD, what is a non-real estate related bucket list item that you've recently checked off, you're excited to check off next?
I got to go to the College Baseball World Series in Omaha, Nebraska a couple years ago. So I played baseball through college, love baseball. And so getting to go to Omaha was a treat.
That's awesome. That's great. All right. What book are you currently reading?
So I am currently reading, and I'm drawing a blank on the name of it. The one that I just got done with not long ago was Who Not How. And that was great.
Yeah.
For me, because I am the guy who, I'm a lone wolf warrior. I think I can do everything myself. I think I can do it better than everybody. Don't want to have anybody help me. And I could be my own bottleneck. We were kind of talking about, just scheduling podcasts, it's
yeah.
like, somebody else is doing it for you. You're like, oh, is it really getting done? And so, shifting my mindset from how do I get this done to who can do this for me, has really transformed my life. And it's a work in progress, but I can see, I've done a good job so far, need to get better, but just implementing it for the short amount of time I have has really freed up some time.
Yeah, that principle is so interesting. I was talking to some the other day, and we were talking about some business owners that we've ran into and stuff. We're like, man, there are some idiots out there that own businesses. Like, these people are not sharp. You're like, my goodness. And it's like, the thought that came to me was, sometimes when you don't know how to do things, you find people that do. And sometimes people like you who are actually well-rounded enough to do everything yourself, it's hard to find other people to do. You're like, I can do it. I can do it. I can do it. I can do anything. And so you do try to do it all. And then sometimes you get these people who, man, they can hardly do anything. So they get other people to do it on. They're running the business. You're like,
yeah.
Oh, okay. Like, I guess I could take a lesson from that,
And a lot of times you probably can do stuff better than the other person.
Yeah, like, for sure.
Oh, you have to be okay with 80% less than you if you're going to scale. That's what I've come to.
Yeah, it's the only way to really grow and to give yourself any sort of freedom and flexibility. Is like, you got to be able to let other people do it, even if it's not going to be done the way you want,
Exactly.
Which again, for the untalented, ignorant person, that's easy because they're like, yeah, let anybody do it. For somebody who's actually good at stuff, that's hard to release those reins, but it's key.
Agreed.
Awesome, man. Well, third question, is there any specific content, any other books or courses, podcasts, YouTube channels, anything like that, that just you've really enjoyed lately or overall that you would recommend people check out? Besides, the ones we're associated with.
Yeah, for sure. How I Built This by Guy Raz, however he pronounces it. It's an NPR show, but it just talks, he interviews business owners who started, businesses and that grew, like big businesses, like ones that you guys would all know. And it is very interesting to hear, for me, humble beginnings, and then listen to their journey and to how they grew it into these, billion-dollar businesses. So that one is one of my favorites.
How I Built This. Awesome. I like that. Everybody go check that out. All right, man. Last question. We're going to let you go, and then everybody's phones are going to blow up with a text message from JD, the Finance Cowboy. What's the text message going to say?
If I'm sending out a text to the world, it's going to say, Jesus loves you. Follow Finance Cowboy on Instagram.
There you go. First things first. And then coming in a close second, follow me. I love it, my man. Well, this is great. Well, thanks so much for being on here. This is super fun. We should definitely do this again, maybe do on rehab. There's so many different aspects to it, but everybody can go check you out and keep learning from you directly as well. So we really appreciate the time. But yeah, man, without any further ado, this is Joe Jensen signing off for the Real Estate Investing School podcast, reminding you that it's riskier not to start.